Okay, guys, moving forward. So we're moving on to our final piece of this lecture with gaps, fair value gaps, imbalances. Really important stuff, really relevant to the liquidity zones that we've been talking about and how to identify sort of setups based on those supports and resistances. So gaps, one of the most visually obvious but often very misunderstood features on a chart. A gap is basically a discontinuity in price. It's where a stock or futures, whatever you're trading, contract opens at a significantly different level than it closed in the previous candle, and no trading took place in between. So you'll spot them very easily because there's blank space in between the two candles. And that's on an immediacy. So the close of a candle body, the open of the next body, there is clear space between them. It could shut that gap very quickly, almost immediately, or it could leave it behind and then we have a magnet zone. But that clear space is what we're saying when we're talking about a gap. You'll spot them very easily, but not all gaps are the same. And there are sort of four main types of gap, and each one will tell us something different about the sentiment and the structure of what's going on. So common gaps, these are just the common minute-to-minute candle gaps, and they happen without any major catalyst. Maybe some overnight imbalance, maybe low volume, maybe it's just market noise. But the key thing to know is that they usually get filled pretty quickly. Price tends to come back and close the gap pretty soon after it forms. And with everything, that's not 100%. That's not a guarantee every single time. It's just the commonality. And they will act as magnets later. So if price returns to that zone later, that gap will act as a magnet. So unless they occur on a very significant level, we don't really treat them as high conviction events, but we know that that level is something that we could trade and could scalp. So it's something we keep our vision for. The second one is breakaway gaps. This is where it gets a little bit more interesting. The breakaway gap happens when price gaps through a major support or resistance level, or out of a consolidation pattern. These gaps tend to signal a change in structure, a breakout, usually with strong momentum, and we watch how price reacts after the gap. If it doesn't come back to fill, it's often a sign that the buyers or the sellers are fully in control. So for example, if it gaps up out of a pennant, out of a consolidation pattern, and then the next candle continues on the way up, doesn't come back immediately for that gap, then our inference is that, okay, buyers have taken control from the end of this consolidation. The immediate momentum is to the upside. That's what we should be looking at. We don't want to bet against expanding buyer volume for a 1 minute gap. But now we know that that gap is there. The third one is runaway gaps. So these happen in the middle of strong trends. So what we just talked about, continuing on, if it continued the buyer expansion, they're generally caused by momentum. So often this means it's institutions piling in. It's not just you and me. It's not regular people. It's large institutions piling in. Or it's crowd mentality. So it's all of retail going in a specific direction. So you'll see price skip levels, basically leaving untouched zones behind it as it accelerates and the volume expands. And these gaps often signal continuation, not reversal. As we just talked about, if the volume is expanding in whichever direction it's already going and it's leaving these gaps behind, the immediate inference is that the buyers or the sellers, whoever it happens to be, are in control and price should be continuing. And the last one is exhaustion gaps. And these are the opposite of what we just talked about. So you think of them as the final push before a reversal. And they usually happen at the end of an extended move, or it's the overextension of that move. Price will gap up, it'll fail to continue. So it'll gap and then immediately start failing the direction it's going in. There'll be no follow through. So if we're talking about our example where buyers are in control, it gaps, buyers are just not there anymore. They're exhausted. Sellers immediately take over. That's where you see buyer volume would immediately dry up, start wicking to the upside without any continuation. And then we would see the alternate side, the sellers in this case, step in, push it immediately back down and start filling that gap. And that's when the trend is then running out of steam at that point. So the bottom line is that understanding the type of gap gives you an edge, not just the ability to spot the gap. And you want to ask yourself when you see these gaps, is this gap something to chase? Is this gap something to fade? Or are we waiting for a gap to fill and then make a move after that? So you always want to tie it back to whatever structure that you're looking at and not just trade the gap in a vacuum. So we're going to jump over to the chart very quickly. And I know that there was a couple of gaps back here at midday. So real quick, can identify these very quickly here. There's a gap. This is exactly what we're talking about. The clear space from the close of this candle to the open of this candle. There's clear space here. That's a gap. The large body red candles here show us that, in fact, this was a gap too. It's just that price wicked up before it went down. So it had a gap into another gap. We would think to ourselves, sellers are in control here. RSI was matching that, but the volume wasn't really expanding. So we're looking and we're thinking to ourselves, this probably doesn't have the legs unless it started to really knife down here. You can see that there's, what have we got here? That might just be a dragonfly doji. But then it immediately stopped and started to come back up. And you can see these wicks filled this gap. So price made its way back to this zone just to fill this gap and then continued down. It actually left another gap on the way back down. So price made its way back up just to fill the gap to rectify the imbalance, and then sellers immediately took over again. They left another gap, which it actually took a much longer time for price to find its way back up. It didn't fill it until over here. That's 15 or 20 minutes. I wouldn't say that price made its way up here specifically to fill the gap, but what I would say is that once price found consolidation here, so we've got a low and then a higher low, you start moving up. If you're entering here, you probably have yourself a target in this area as a minimum. You know that price is coming back to this area as a magnet. And that's how we would be looking at gaps in some contexts. And here's just a still example of what we're talking about. Clear space between, and in fact, this one didn't make its way all the way back down. So it left a gap behind and it went all the way back up. You can see further to the right over here, price did make its way back down. Again, the gap probably wasn't the only magnet, but once price starts moving in that direction, that we know that's where it's coming to. This is actually nature abhors a vacuum. So that's a very common saying just in general. That's not market specific, but it is very market applicable. Nature does abhor a vacuum, and the market, if nothing else, is an efficient beast, and it's kind of like nature. Okay, fair value gaps. So you'll see FVG is the acronym for this one. You guys will see a lot of this with Tolman's trading in the ICT space. This is a very key concept that he's wonderful at teaching. It's a very key concept that you can use whether you're strategizing ICT or not. It's just the concept of an imbalance on the ledger, which the gaps that we just talked about, they are also imbalances on the ledger. So this is just a different way to look at it and to assess it. So let's break down what they are. It's one of the most powerful concepts for identifying inefficiencies in price. That's very key. Inefficiencies is what we're talking about. And it becomes a critical part of your edge once you know how to use it. So first, a fair value gap, just in general, is simply the agreed upon market price where a buyer and a seller are both willing, fair value is the agreed upon market price where a buyer and a seller are both willing to transact. That's what fair value is. It's just there is a participant on each side of the trade. And it's what we consider balanced. When there's no urgency on either side, everyone's just willing to trade. And in the real world, and especially in a fast-moving market, the balance doesn't always occur perfectly. And this is where fair value gaps come into play. A fair value gap is a price imbalance, a zone where the market moved too quickly in one direction, leaving little to no opportunity for the buyers and sellers to interact at an equaled fair value. So visually, it shows up as a 3-candle pattern. You'll see a large candle in the middle. That's the imbalance. And the first and third candles form the edges of the gap. So we're going to just jump through, and this is the visual example of what we just talked about. 1, 2, 3 candles. This middle candle, we've got the top of the first candle, we're going to use the wick, not just the body, and the bottom of the third candle. Everything in between here, because we're on the 1 minute, we're on a very small time, or the smallest time frame that we're going to be using. Everything in here was just buyers. So price moved up very quickly. You can see this was a very buyer heavy move. And it left this zone here where there was no ability for the sellers to sort of transact a fair value. It was just buy, 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 and volume continued to go up. The ladder started to climb, and there was no agreement of fair value. And this tells us the market moved very aggressively. Buying pressure was just overwhelming the other side, and there's no back and forth. It's just directional aggression. So that's the concept here, directional aggression. So why does that matter? And the key is that price often returns to fill these gaps / imbalances because the market likes efficiency, and efficiency is an equaled out ledger. It's not all buyers or all sellers, it's an equaled out ledger. So if there's no proper auction, and that's what the ledger is here, both sides, it's an auction, at a certain level, then there is unfinished business or an inefficiency. And in this case that we're talking about here, the inefficiency is because it's all buyers on the ledger. There's no sellers on this ledger here. So now we have an inefficiency or an imbalance. So it doesn't mean that we just fade or buy into every single imbalance. We have to know the structure. We have to know where it's going to go and when it's going to come back. The context rules still apply. But if price is moving towards an FVG, just like with the gaps, that's a clue. It can act as a magnet. It can be a retest, a continuation. It could just be a trap. Depending on volume and structure and time of day, everything that you would generally contextualize your trades with. So when you see an FVG, you don't just mark it and say price is going here. You ask yourself, was it formed on high momentum? Did price react to it previously? Has it already been revisited somewhere else? Is this a spot where liquidity is likely to be hunted, or is this something that's going to be forgotten about until later? So spotting these visually is the first key, and then using all the other tools, the context that we have, is how you effectively trade them. And to give you an example, this is the end of the session today. This is 3:40 p.m., and the end of the session was just over here. So we can see the first example. I'm going to make everything a little bit bigger. The first example here, you can see doji candle down here, large inefficiency, all buyers. Next candle, barely wick down at all. So now that yellow zone is our FVG. It's this huge inefficiency of this candle. Now, this giant wick to the upside, and then this next wick with an equal body top. This is a tweezer candlestick pattern. Two to the top, we got a tweezer with an equal body. So sellers stepped in almost immediately and then started pushing back down. Now you can see that we've re-entered the FVG almost immediately. It was about 2 minutes between. The thing that we're identifying in this first example is that the bodies are not closing below. The bottom of this yellow zone is the bottom of our fair value gap. No candle bodies are closing below it. They're wicking below it, but then bodies are being pushed straight back up into it. And what you can infer from that is that in this zone, all over here, this is buyers. Buyers are still sitting here. Participants are waiting to buy. So every time price came down here, buyers pushed it back up. Price came down, buyers pushed it back up. 3 more times, pushed it back up. So because we've got a low and then a higher low, bodies are not closing below, and it's all buyers on the wicks. Bodies are not closing below. We now are saying to ourselves, okay, this zone is holding. There's going to be a long entry somewhere along here. Similar to the other concept we talked about just before, then we apply the polarity principle. Everything starts coming up. We come to this same high, and bodies are not breaking above it yet. So we don't have our full confirmation. But this level here, the top of the FVG, has now, the polarity's been flipped, and you can see these candles came back down, and the bodies were unable to break even lower. They were held on this level. So now we know this is a support level. What was previously a resistance where these wicks are is now acting as a support where these bodies are, and it started to push up from there. So if you were looking at a long entry, potentially you're entering here if you have a higher risk tolerance and you're setting your stop loss back here. In this case, you would have been rewarded. If you're more conservative, you're entering in this area after the retest, and you would have been rewarded pretty heavily as well for that. The other example over here, we're seeing same thing, green, big inefficiency, and then a hammer at the top. But we've got our FVG has been generated. Price didn't even make it back down into the zone or below the zone. You can see that it wicked in 2 or 3 times. This giant wick is closing the imbalance. This long wick, but it's all buyers sitting here waiting to buy it. But the point of what we're talking about is that the FVG is the inefficiency. The market brought price back down to close that inefficiency and then sent price back up. So price didn't run away. It came back, balanced out the ledger, and then moved away. And that is the key concept with these FVGs. Based on the structure that we're looking at, we know whether we can use them as breaker blocks. We can know we can use them, whether we can use them to go long or to short or to fade, whatever we need to do. So that's the vision that we're going to help build by understanding these core tenets.